Hey everyone, welcome back to the channel. I hope you're all doing well. Today we're diving deep into a topic that's been on a lot of investors' minds lately, tariff talk. There's been a lot of noise in the market, but according to Tom Lee, the managing partner and head of research at Fundstrat, tariff discussions have more bark than bite. We'll break down what exactly he means by that, and why this may actually present a buying opportunity for investors. Before we jump in, if you're enjoying the content, don't forget to subscribe and tap that like button. It really helps me out and helps bring more insights to you. Also, be sure to check out the resources and links in the description below to keep up with the latest market trends. All right, let's get into what Tom Lee is saying and why his perspective matters for your investment strategy. Market overview. What's the deal with tariff talk? So, let's start with the big picture. As many of you have probably seen, tariff talk has been a hot topic lately, especially with the White House weighing in. There's been a lot of concern about how these tariffs could impact the market. In fact, markets reacted negatively to some of the headlines in January and February, with investors feeling uncertain about how tariffs might affect everything from inflation to corporate earnings. However, Tom Lee doesn't seem too concerned. He argues that, despite all the drama, the impact of tariff talk has been more noise than substance. In other words, it's been more about headlines and political maneuvering than it has been about actual game-changing shifts in the market. Now, why does this matter? Well, historically, when the government threatens tariffs, it creates volatility. You may see short-term market drops when new tariff talk arises, but over the long term, the market tends to absorb these changes and rebound. This is what we've seen in the past couple of years when similar tensions spooked investors, only for the market to rally back in a matter of weeks or months. So, while the tariff concerns are real, Tom Lee's view is that they are temporary blips rather than long-term threats to the market's overall performance. Fed policy and inflation concerns. Of course, it's not just tariffs that are on the market's radar right now. The Federal Reserve's policies are another big concern, especially as we see mixed signals about interest rates. One of the biggest questions investors have is whether the Fed will continue to hike rates in 2025, or if they'll start cutting to support economic growth. Tom Lee thinks that there's still a 20% chance the Fed could hike rates this year, despite most investors thinking it's unlikely. That's not a huge chance, but it's something to keep an eye on. If the Fed does raise rates again, it could create some market volatility, as higher rates would mean higher borrowing costs for businesses and consumers, which can slow down economic activity. However, as Lee pointed out, the bond market doesn't seem as worried about this as some might expect. If you look at yields, the 10-year bond has backed off from 4.8% to around 4.5%, which signals that the market isn't too concerned about additional rate hikes just yet. But here's the catch. If the Fed hikes rates despite the slowdown in inflation, it could cause what Tom Lee calls a policy error, and that's something we definitely want to avoid. The market could panic if the Fed tightens too much, especially if it puts the brakes on economic growth too quickly. At the same time, if the Fed cuts rates, we could see a rally in stocks because cheaper borrowing costs would stimulate spending and investment. It's really a delicate balancing act for the Fed, and it's something we'll all need to keep an eye on as 2025 progresses. The resilience of the market, why this is not 2022. Now let's talk about the overall market resilience. Despite all the concerns, Tom Lee pointed out that we've had a strong start to 2025. January was up about 2.7%, and historically, we tend to see sell-offs followed by rallies throughout the year. So far, the market has proven itself to be quite resilient. It has been able to absorb everything from pandemic shutdowns to geopolitical tensions to rate hikes without losing momentum. In fact, since 2023, we've seen back-to-back 20% gains, and while people thought the market might cool off after such a hot run, 2025 has started off with a similar trend. Yes, there will be ups and downs, but the broader market remains strong. The key takeaway here is that the market seems to have developed a stamina that allows it to absorb the punches and keep moving forward. That resilience is especially evident when looking at stocks in sectors like tech, industrials, and small caps, which continue to show strong growth potential despite the uncertainties. Earnings reports, mixed signals. Let's shift gears a bit and look at the earnings reports that have been coming out. So far, the earnings season has been a mixed bag, and it's giving us some interesting clues about where the market might be headed in the short term. For example, Microsoft posted a solid quarter, but its guidance wasn't as strong as investors hoped. That caused a slight dip in its stock price. On the other hand, Tesla missed its earnings estimates, but the stock didn't fall off a cliff. Instead, it consolidated for a bit before bouncing back, which is a good sign that investors still have confidence in its long-term prospects. Then there's AMD. The company posted strong year-over-year revenue growth, particularly in its server business, which was up by 69%. However, the revenue growth didn't meet expectations, which caused the stock to dip. As you can see, these earnings reports have been a mixed bag, but that just shows us that not every company is going to perform the same in this environment. The key here is to stay patient and look for opportunities in companies that are being undervalued due to short-term concerns. Where should you invest? So, where should you be putting your money right now? Based on everything Tom Lee and I have discussed, there are several sectors that still offer solid opportunities. Small caps. These stocks have been underperforming in the past couple of years, but Tom Lee is optimistic that they will catch up. Small caps tend to outperform during periods of economic growth, and if we're heading into another strong period, this is where you'll want to be. Industrials. Companies like Caterpillar and J.B. Hunt could see growth as we continue to recover. These stocks tend to thrive when the economy is doing well, and with PMI data showing expansion, it's a good time to look at these types of stocks. Financials. Tom Lee also likes banks like Bank of America and Citi. As interest rates stay elevated for longer, these companies can benefit from higher net interest margins. Tech. While some of the big tech stocks, like Microsoft and Meta, have been showing weakness lately, don't forget that the fundamentals haven't changed. These are still some of the strongest companies on the planet, and if their stocks dip, it could be a great buying opportunity. Consumer staples. Companies like Johnson & Johnson and Apple are always good to keep an eye on, especially when we're dealing with uncertainty. These companies provide stability, even in volatile markets. Closing thoughts. To wrap things up, the market in 2025 is still proving to be resilient, despite the challenges we've discussed. Whether it's tariff talk, inflation concerns, or Fed policies, there will always be noise. But that doesn't change the fact that the market